Whenever I speak to entrepreneurs or small business owners who are struggling with their finances, they all have one thing in common. They don't separate their business from their personal money. The golden rule in managing your finances as a small business owner is to separate your business and personal finances. You need to think of yourself as an employee of the business. And just as much as you would never tap into your employer's bank account to make ends meet, you need to treat your business in the same way. Start by having a separate business bank account. This is where all the income for the business is paid and where your business expenses are paid from. So this includes your salary, because remember, treat yourself as an employee. When it comes to choosing the right bank account, it all depends on your business. If you're trading as a sole proprietor, you do not have to open a business bank account, which tends to have higher fees than a personal bank account. However, the advantage of doing so is to build up a track record of your business with your bank. This becomes important when you want to start creating lines of credit. Some banks, for example FNB, even offer 0 monthly fees for sole proprietors. Apart from your business's transactional account, you must have several savings accounts linked to your bank account. These are extremely important to help you manage your cash flow. And it shouldn't cost you any extra money, as most business accounts offer linked savings accounts at no additional monthly fee. The first savings account is for tax. The cash flow crunch always comes when businesses fail to provide for that SARS bill. And they often get caught out having to rely on loans or even cashing in other funds to meet that tax obligation. Your accountant should be able to tell you how to estimate the amount of tax you need to put away each month. This will be based on your business's tax profile. So whether you're taxed as a sole proprietor, as a company, or if you pay turnover tax. If you have employees and you have to deduct PAYE, this must also be set aside immediately. If you're a VAT vendor, open a separate account for VAT and immediately transfer 15% of all your paid invoices into this account. Remember, you are a custodian of VAT. You are effectively collecting it for SARS. When it comes to paying VAT, you will probably have input tax that you can deduct from your VAT return, which means that by putting away the full 15%, you're actually building up some cash reserves. Which brings me to the third account you need to open. This is for your contingency fund. Here you will build up a buffer for bad months. Ideally, you want to build up about 3 months worth of operating costs, but at the very least, make sure you have enough money in there to cover your salary for 3 months. This is effectively your business's emergency fund, and it allows you to smooth over those tougher trading months. If you have a capital-intensive business, you also need an account to build up capital to pay for input costs. So, for example, you may be a plumber and you need to pay for the materials up front. If you do not have that capital available, you could face a cash flow crunch or end up taking on debt. When selecting the savings accounts, look at what works best for you. A 32-day notice account may give a better interest rate, but personally, I never remember to give enough notice when it comes to my tax payments. So I generally prefer a 7-day notice or even a 24-hour call account. You could even consider a unit trust money market account for larger amounts. Personally, the way I feel is that as the interest rates are not that significantly different, convenience is more important to me. You'll be surprised at how implementing this system of allocating money into pots automates your cash flow management. Respect your business as an asset. Don't treat it as an ATM.